All right, welcome to the Sherman Show. I am Jeff Sherman, along with my co-host Sam Lau.
Hey, hey.
And even though Lau didn't put it on my little cheat sheet, today is Thursday, May 4th, 2023, for compliance purposes. Everything Michael says here today will be recorded and put out there, but it's as of May 4th and not as of any other date. So those of you who don't know who is with us today, I said Michael already. I gave you a little sneak peek. We have Michael Feroli. He is JP Morgan's Chief U.S. Economist. Mike, big fan of your work over the years. I think you put out a lot of great stuff. We just had a Fed meeting, so we figured what better day to bring you in than after we just heard from our Fed chairman that the banking system is sound and stable. So again, welcome to our show.
Yeah, thanks. Good to be here, Jeff. Yeah, let's hope. It was interesting. I think he gave a few hints there, and presumably the Fed has, through their stewardship of FedWire, a little bit more timely look into bank deposit situations than, the H8 is delayed by 10 days. So
10 days, yeah.
Yeah, so it's kind of hopeful that he once again, like he did at the March meeting, signal or say that the deposit situation looks stable. So hopefully, he's not getting us off the track there. But I think that's
yeah. Well, it's also a function of, are you looking in aggregate that there's stability, or is he going case by case, which I think is what kind of the market's looking at this point, right?
Yeah, of course. I mean, having deposits flow from smaller banks to more stable GSIBs is not going to be what the doctor ordered right now. But presumably, I think Powell knows that he certainly knows that, and I think that's what he was trying to communicate yesterday.
Yeah. So I know we jumped into it. I can't resist talking, wonky, Fed speak with an economist. So maybe just rewind a little bit. Maybe you can give our listeners a little bit of background on who Michael Feroli is and how you got to where you are at JP Morgan today.
Yeah, it was a pretty circuitous route, I think, compared to most of my counterparts. So I actually studied philosophy undergrad. I started a grad program in philosophy. I was going to get my PhD in philosophy. And then at a certain point, I realized I wanted to kind of get back into the hurly-burly of the real world. Pivoted and got my PhD in economics from NYU.
Okay.
After that, my first job out of grad school was at the Federal Reserve Board in Washington, D.C. At that time, Alan Greenspan was chair. Ben Bernanke was a governor, so I got to see both of them in action, and an interesting comparison and contrast of their, thought styles of thought. I guess one would say. So I was at the board, what we call the board, what most people call the Fed, the Washington-based Fed. I was at the board for about 4 years, and after that, I decided to jump over to the private sector, and JP Morgan came calling, and I came to JP Morgan in early 2006 and have been here ever since. So that's kind of how I got here.
Yeah, it's funny. I don't know if it's funny, but it's interesting. You said you started, with philosophy, then went to the real world of economics. I know another successful finance person that studied philosophy, and I call him successful because he's also my boss. So that's where Jeffrey Gunlock, he started off. He was a dual math and philosophy major, and he was saying that the dissertation he wanted to write was the non-existence of infinity, and trying to bring the two things together. And his advisor wouldn't let him. So anyway, but let's talk about that real world too, because there's been a lot of punditry that's been speaking about potential disconnects between financial markets today and the real economy. And what is the real economy? To a lot of people kind of call it Main Street versus Wall Street, right? It's a nice little sexy little hook to put in there. So what are you seeing in the economy today? As you kind of look under the hood, you see the evolution of things, and let's keep the banking system aside right now. Where were you, let's say at the end of February, thinking about the economy, and potentially how does that look different today? Or, again, just kind of laying out what the roadmap looks like today in the U.S. economy.
Yeah. So, I mean, if I had to just summarize it in, a few words, I think the economy still looks very, most growth indicators still look pretty robust. And I think it's interesting. It feels like we are still, even now, 3 years after the pandemic, still really living through the aftershocks of that. And in particular, I think what you see, and I know I don't want to jump the gun by going straight into the labor market, given that this is jobs week after all.
Yep.
You look at some of the areas that are, continuing to show really above trend growth in hiring. It's a lot of the catch-up hiring from the pandemic. In particular, I think everyone knows about leisure and hospitality, or talks about leisure and hospitality. But I think equally as important is healthcare. Healthcare hiring healthcare employment is still almost 1 million below the pre-pandemic trend, which, we generally, and I think what's interesting about this is, healthcare is obviously a very important part of the economy. We generally think of this as being a very acyclical part of the economy, and yet you're seeing some really strong growth from depressed levels. And I think, and another interesting aspect of that is in both leisure and hospitality and healthcare and education, these are all sectors that are, historically, for good reason, considered very interest insensitive. And so you think about the tool the Fed has is really just one tool, is the interest rate. Generally, you think about it works well on construction and manufacturing, or let's say construction and the goods economy. So manufacturing, and then maybe trade, transportation, warehousing, kind of all that goods infrastructure space. And you are starting to see, I think, some of the intended effects of those rate hikes in that part of the economy. But the part that, loosely speaking, the Fed doesn't control is growing at such a, continues to grow at such a brisk, above trend pace that I think it creates this, forecasting challenge for them, which is particularly, I think, Jay Powell, maybe for good reason, doesn't, maybe he felt he got burned by forecasts in the past and doesn't show a lot of faith in forecasting. And so, you're working on this economy where you think some of this above trend growth in these interest insensitive sectors should peter out over time. And so therefore you might not want to overdo it now, but it does, I think, create a bit of a challenge, because oftentimes when you think about the way the business cycle works, is generally those interest sensitive sectors are the ones that get kind of frothy toward the end of the cycle, right? So it's kind of like, it's a nice kind of divine coincidence that the Fed's tools tend to work on the sectors which get, a little bit out of whack when the cycle is long tooth. Now I think that sort of divine coincidence is a little bit broken, which creates some dilemmas here for the Fed.
So you mentioned it being broken, and I want to come back to something else you said about the interest rate sensitive, but you talk about it potentially being broken. As I thought about this coming into 23, I was of the mindset that maybe this transmission mechanism, albeit not broken, is delayed. Yeah. With some of that being the refinancing of corporate America, the consumer, refinancing the mortgages. And so usually when the Fed is hiking, you're trying to slow down the credit creation through higher interest rates, but so much of the weighted average cost of capital is so low, right? Yeah. And so is how does that factor into your thinking right now? And again, you mentioned kind of that manufacturing component that it is, because they run kind of they have cash flow needs, right? And so they need to borrow more frequently. So how do you think about that? And is it not that it's broken, but it's just been somewhat delayed through the cycle?
Yeah, no, I do think. All right, so you always have long lags, and I think if you look at historical parallels, one of my colleagues, he's kind of actually has a note out coming out of it shortly, is what we're seeing now is not at all that unusual in terms of not having the unemployment rate increase, within a year after the first rate hike. So there are lags, and I think if I'm interpreting you correctly, I would think actually that the fact that corporates have termed out so much of their financing should actually make the lags longer. Right?
That's where I was going with it, right?
Yeah. So,
but the Fed put out a paper that said the lag should be shorter this cycle because of forward guidance, right? It's almost like a pat on the back, like we're doing a great job. It's already in there, right?
So I think there are arguments. There are arguments that go in both directions. I think in terms of lags, certainly humility is warranted, but I think when it comes to cost of capital, definitely it should stretch out the lag length. A friend of mine made this analogy, which I wish I thought of because I think it's so great in terms of thinking about just what you're talking about, which is, you go to the gym and you do a plank and it's easy for 10 seconds, but after 2 minutes, it's not so easy. So we're at 5% interest rates and everyone's like, oh, look, the economy looks fine. But the longer we're at 5% interest rates, the more that debt structure has to get refinanced at higher rates. And the more that's going to pressure certainly corporate profitability. So we do think that, given all that, I think it makes sense, for the Fed to pause here, which seems to be what they signaled, yesterday, albeit tentatively.
What do you make of the bond market saying that the Fed's done at this point? I mean, one point yesterday we had like a 5-10% probability, which is effectively zero, right? Or it's so close. It's infinitesimally small, but there's probability of a hike. Then as the day went on, it's like there's no more hikes. They kind of have this curve leaning down. It's obviously not the path. The Fed's not going to follow the path of the bond market. But what do you make out of what the bond market is signaling? I mean, look, the 2-year Treasury is at 375 today, or at least it was, and 30 minutes ago. And so it's at 375, but you have Fed funds here on the upper end at 5.25. Kind of said the bond market says you're not staying there very long. What do you make of all of that, putting those two things together?
Yeah. So first of all, one thing I would say about the pricing for June, and I think the rhetoric more generally coming out of Powell yesterday is, when I look and listen to Powell, I think he reminds me in some ways of Greenspan, and that Greenspan, I think Greenspan liked discretion, and Greenspan liked the option to do what he wanted to do, regardless of what the models, optimal control models, or whatever else would say. So I think Powell kind of wanted to preserve a little bit of that optionality to exercise discretion at the next meeting. Now, in terms of the pricing of cuts, and I think a number of analysts in the interest rate market have made this observation, is that the market isn't saying the Fed's going to cut exactly whatever number, but they're pricing in some probability, some tail probability that even if your most likely scenario is to believe the Fed that they're going to be on hold this year, you can't but think there's a decent chance that you could have a much more rapid pace of a much more rapid cutting cycle, particularly again, I don't want to jump the gun here. Debt ceiling has come into focus this week with the letters from both Secretary Yellen and CBO Director Swagel. If we go off the cliff there, it's not hard to have a scenario where the Fed has to cut pretty aggressively. So if you want to, I don't know what type of probability and how exactly you're going to arrive at that probability, but if you want to put in some probability for us going off the cliff, either by design or by accident, then the pricing doesn't seem that crazy, even if you kind of believe what the Fed is telling us.
Right. I mean, a 25 basis point cut within a couple of meetings is just 10% probability of a 250, right? Like, I mean, you can mathematically get there, is what you're saying, right?
Yeah, exactly. And I don't think I would imagine even the Fed. Well, actually, it feels like the Fed has stopped protesting the market pricing, right? So if you roll back, I think about 6 months, it felt like there was almost this like petulance about, why is the Fed, pricing cuts here? And I thought yesterday, one of the things Powell was pretty, well, obviously scripted and prepared to tread around was this idea of the market pricing cuts. And he just said, look, everyone has their own economic scenario. Our scenario is that the economy, inflation is going to be relatively sticky coming down. And so we're going to need to stay here. And, just kind of laid it out without protesting. I thought the market, which is, I think that's what they should be doing, which is saying, everyone's free to have their own economic scenario. We just want to make sure that, how the market sees us responding to those scenarios is like properly tuned, right?
It's funny because he did say that like 2 meetings ago, right? He said, well, I'm not here to debate forecast. The bond market's different than that. Like we all have different. So, I mean, he kind of did say that previously. So maybe he just felt I don't have to repeat myself. But one thing before we shift gears, I know Sam has a bunch of questions too, and I'm hogging all the time here. But you mentioned about the monetary tool, and there's a question in the press conference that was talking about the separation kind of theorem. I'm talking mathematical separation theorem, the separation principle, of the financial stability versus monetary policy. And so, now we're sitting here with the banking problem. They've kind of resurrected, or created some new facilities to help provide liquidity. They've opened a discount window more frequently. They've done some things for, let's say, financial stability. Does that, in your mind, does that conflict with what they're doing on the rate side, right? Because they're providing liquidity to help ease conditions in some way, but they're tightening. Like, how do you think about that separation principle, not theorem?
Yeah. So, I mean, I think the first thing to I guess mention is, so arguably Bernanke coined the term separation principle in 2000. I believe it was 2006, right?
Yeah,
so,
I think that's right. Yeah.
Yeah, I think it was use the right tool for the problem, right? So if you have financial stability, use your supervision, regulation, lender of last resort tools, and then for the macro economy, use your fund rate. Now he got a little bit chastened by that, and I think in 2010 gave kind of a mea culpa speech where he said, "Look, these things always bleed over, and the financial stability problems are going to affect the macro economy and vice versa, actually." So now that being said, yes, that's trying to slow the economy. But I'm very sympathetic to what they're doing, which is you want to slow it in a in a controlled kind of linear way rather than having a string of bank failures, right? So I don't think that's to me kind of a problem. And in some ways, the separation principle is almost kind of written into the Federal Reserve Act, where Congress has given them a bunch of different responsibilities, and so I think they're trying to meet all those responsibilities at the same time, rather than say, all right, our macro responsibility leads us to kind of have to jettison our financial stability responsibility. But I did also think that Powell kind of tried to almost get the second version of Bernanke in there yesterday, where he said, let's not get too cute about neatly separating these things, because you just can't do it, right?
Yeah. We always want to distill a complex system into basic terms. But Sam, I promised I'd let you ask a question, so let me shut up for a second.
All right, let's keep it on Bernanke kind of, but shift it more towards just, I guess, the economy side then, because I know he was doing a little dancing up there yesterday, as he always does. He's gotten a lot better at it, but the notion of soft landing was brought up again. He kind of sidestepped it a bit, but just interested in hearing your views on economic activity here in the U.S. in light of monetary policy, perhaps people dubbing it the hawkish pause. We've got the debt ceiling, a whole host of issues out there. We're going to wait to see the jobs market come out this Friday.
Yeah.
There's a narrative of the rolling recession out there before. We could potentially even avoid a soft landing, have no landing type of scenarios. Do you think it's possible? I mean, under this, things are starting to build up. We always say that the Fed continues down their hawkish, aggressive tightening until something breaks. And it's hard to say at this point that perhaps cracks aren't forming, at least in some corners of the banking, sector there. So is a recession avoidable this time around? All right, let's just call it for the next 18 months.
Yeah, I guess I would kind of rephrase the question as can we have a adequate disinflation without a recession, right? In other words, if you can say, oh, we avoided a recession, but we haven't disinflated the economy back down to 2%, well, then the Fed's going to have to do more, which probably gets us to the recession. So now the question is, can we get back to 2% without a recession? The models would say probably not, right? And I actually presented a paper with a few co-authors earlier this year, which was commented on by a few Fed officials, where we said, if you just look at a basic Phillips curve model and kind of invert it to get core PCE from 4.6 to 2, the kind of unemployment rate that is usually associated with that would be a recession, right? So then you say, all right, how could that Phillips curve be wrong? I think there's a lot of ways it could be wrong because Phillips curves haven't done a very good job, particularly in this cycle. So one thing you could say is, well, look, this inflation is very poorly explained by the Phillips curve. So even if you do, which we did in our paper, a lot of almost jerry-rigging to get slack to drive the inflation story that we've seen. And when I say jerry-rig, use the vacancy to unemployment ratio instead of the unemployment rate itself, or you put in some nonlinearities, and then you can get slack explained getting inflation up to 3 and change. But you can't get it to explain all the inflation that we've seen. So you have this error term. If you assume that error term kind of reverses over time, then the amount of kind of intrinsic slack-driven disinflation or slack-driven inflation that you need to reverse isn't maybe as big a hill to climb, and that you can actually get by without that much damage to activity. And I would say one of the interesting things that we've seen, and Jeff mentioned the date earlier is earlier this week, we saw the JOLTS number, which job openings continue to come down. And one of the interesting kind of debates we had started last year between some heavy hitters, Blanchard and Summers on one side, and Chris Waller and Andrew Figueroa, former colleague of mine, that had this debate about how much, I mentioned a moment ago, the vacancy to unemployment ratio. How much normalization of that can we get through a decline in vacancies, which is kind of painless, versus an increase in unemployment, which is painful. And we have gone over the past 6 to 9 months from that ratio being 2 to being 1.6. Now, normal could be maybe 1.2. So we've almost halfway normalized that VU ratio without much pain in the labor market. So without any pain in the labor market. So, there is a case that's not just like completely pie-eyed optimism to say, there's a path to a soft landing. I guess another possibility here is that the recession could be a bit of a self-defeating prophecy, which is if you look at, for example, something like the survey of professional forecasters from the Philly Fed. They do this quarterly survey where they ask, what's your year ahead recession probability? Late last year, that got to the most elevated by far it's been since the survey began in 1970 or around then. So
it's not very common for professional forecasters to say we're going to have a recession, right? I think that was actually one of the questions there, is that you're an implicit forecast from the Fed or recession. Professionals are all saying it. So, we like to say when everybody talks about it, it means it's not going to happen. But, again, I wanted to interrupt you on that just because of that point, right? It is almost the most bearish tone we've seen on the U.S. economy in history. Yeah. Well, at least in financial recorded history, let's say.
Right. Now, I think in financial markets, there's an obvious reason to believe that when everyone believes something, it's not going to happen because it should already be reflected in the price. Now, in the real economy, it's not so simple a story, but one could tell a story whereby, if everyone believes a recession's coming next year, you're not going to load up on leverage. You're not going to, invest in risky projects. You're going to, kind of avoid the type of overreach that usually precedes a recession. So this is sometimes called the Pigovian theory of the business cycle, which is the business cycle ends when euphoria builds up over time, and then something small negative thing happens, but there's so much euphoria that everything has to kind of activity has to really reset. Now, if you never really have that euphoria because everyone's expecting recession, the recession might not come. So that could be another story about why you avoid the downturn, is that it's kind of a self-defeating prophecy. But again, for that to work, I still kind of come back to the inflation story, which is, all right, let's say, that dynamic keeps us out of recession, but then if we still have an inflation problem, the Fed's going to have to restart at some point, which then, then we're going to have to restart the debate about the recession story. So to me, it really just comes down to, whether you can have a painless disinflation.
Well, also on that front too, as you think through it, like as I kind of look back to the data, at least kind of in the post-World War II era, it's kind of been more along the lines, in order to have the recession, it has to be focused on the job market, right? That you've got to see the labor market, you've got to see that erosion there. And as you talked about kind of the early on, was the restocking of employees, specifically in services, at small businesses, like what is it? The bulk of the creation's been at like 100 or fewer employees, something like that. And so now let's bring in the banking system, right? And so what we've seen with the failures with some of the, either the community banks or the regional banks, and they're still more under duress right now. What do you think about the impact of the slowdown in credit in these areas potentially? How do you think about that trickling through this kind of, let's not talk about the mega caps, but more the small to medium enterprises that are reliant upon financing from these institutions? And so does that change your outlook for the labor market or how that goes to the overall economy? Or do you think this is part of the long and variable lags and they're just materializing?
So I think that's a tough question, right? So I think one thing we can all agree is that
we're hard hitters here. You got the heavy hitters. You said we're the hard hitters on our questions.
All right, you definitely expect in any rate hike cycle that the bank credit channel should be one of the channels through which policy slows the economy. Now, generally speaking, what you always expect to happen is that as the Fed starts raising rates, banks realize that tough times are coming. They don't want to lend to less creditworthy borrowers, and so you see credit standards tighten. You don't necessarily have to see a lot of bank failures to do that, right? So bank failures, when you look at the whole list of, by some tallies, there are a dozen channels of monetary policy transmission. Bank failures is not one of them, at least in the textbook. Now, that is contributed, bank failures and the behavior of other banks as they observe this will contribute to that standard bank lending channel that will see tighter credit. And, earlier we were mentioning that, and I guess this kind of circles back to the same point as earlier. I think we were mentioning that this Monday we will get probably the most anticipated senior loan officer survey that I can recall. And it was.
I love the name. I love how the acronym is SLOOS, though. It seems like, I don't know. In this environment, it just feels like a good acronym. I don't know why. Yeah.
Yeah. So it's Senior Loan Officer Opinion Surveys. That's where you get the 2 O's from.
Yeah.
So that was, they asked banks their credit terms of credit, and basically in late April. The interesting thing is the prior SLOOS was from January, and that already was about a standard deviation above normal. So you already saw a pretty significant tightening in the Q1, the January survey. And actually, if you put the SLOOS into a simple recession probit model, that would point, I forget, something like an 80% recession probability over the next year. So already before SVB, you were seeing bank credit availability tighten in a way consistent with past recessions. Now, presumably,
Yeah, I just want to tell our listeners too, a probit model is not something that most people are probably familiar with, but it's just simply a binary type model. Do you have one or not? And then that's what it's trying to do. Just trying to break down, econometrics for our listeners today, Mike.
Yes, sure. Thank you. It has nothing to do with like a colonoscopy or anything else.
Yeah, it sounds really bad. You got slews and probit. It's just not good together, right?
So yeah, it's a simple recession forecasting model, and I think when we get the next slews on Monday, that'll probably point to something like 90, over 90% probability of recession. But as I said, it's not normal, but it is definitely the number of bank failures we're seeing now is not like a part and parcel of rate hike cycles. But it is, I think, it's all obviously pushing in the same direction. Makes us feel, even with the comments earlier about, self-defeating prophecies, still feel okay with an outlook that sees a recession starting in the next 4 quarters, which is our view for what's worth.
How much of this, of the current stress that we're seeing in the banking sector, have to do with the system of banking that we have, namely the fractional reserves? Do you think it's going to bring this under the spotlight again, just based on what we've seen? How do you see that fitting in?
Yeah. It's interesting that the narrow banking school, I think, got a narrow banking school. I thought, they had some a bit of momentum after the GFC for obvious reasons. But for whatever reason, narrow banking never really seems that popular. I think there was a referendum in Switzerland, what was it, 2014 for narrow banking, and they voted it down. It's interesting to think about whether that would actually, narrow banking makes a comeback. Certainly there's a lot of academics, and I forget the list, but it's a lot of prominent academics who, would advocate what used to be called the Chicago plan of going back to narrow banking. But just given, if it didn't catch wind after the GFC, I'm not sure it's going to take off now. So, I would yes, I definitely think this is going to result in, different regulatory response, questions about whether tailoring for bank size is actually appropriate, given, the correlation among smaller banks can create as many problems as a failure at one big bank, right? So I think tailoring regulations for bank size is going to be, I think, scrutinized here going forward.
Yeah, I mean that was kind of when I first thought about SVB signature when that all happened. So I was like, you know what? I think the cost of capital goes up. I think regulation creeps in through that. And you're starting to see it though, but like, we're talking about tailoring to size, but it was like, how is a $200 billion bank, in terms of asset base, how is that considered small or irrelevant, right? In all of this. And so, I guess, it's easy to say with the benefit of hindsight, what happened. But as you think about the credit markets too, and we're talking about this through these smaller channels, do you think there's a disconnect between what we're seeing in what I'll call the capital markets, like the investment grade corporate bond market, the high yield corporate market? Are you seeing a disconnect between that and what we're seeing potentially on this credit side? Or is that just a little premature to be drawing conclusions between these two markets today?
Yeah. So I might be getting a little bit out of my wheelhouse here, but I do find it interesting that, and this kind of comes back to the recession modeling, is that if you look at, just interest rate markets, right, treasury markets, whatever you want to call it, most of those models are showing, well over 50% chance of recession in the next year. I think the Federal Reserve's favored near-term forward spread model is something like over 95% probability recession. Models I see of credit spreads are not really flashing, maybe a little bit of yellow, but not the
Yeah.
amber or red alert that the treasury market is flashing. So it does feel like, that there is a bit of a disconnect there, at least as I look at the signals those two things are sending about the real economy, which, again, is what I probably focus on a little more. I mean, are you seeing it? I'm curious. Do you see it differently, or what's your?
No, I feel that, there's just kind of this, I think the credit markets, they're focusing on what you started with, is that it's that term financing, right? And so if you're financed out for a few years, again, if you don't have a principal payment, you just got to service the debt. And your debt service coverage is low or high, right? Because your interest rates are low. And so I think that's part of what the credit markets are focusing on. But I do see it being a disconnect between the rate side. And like I said, if I'm looking at a 2-year treasury at 375 today, that tells me rates need to be meaningfully lower at some point in the near future to rationalize that pricing. So look, the rates market can be wrong. There is a disconnect, but I think that's why we're all, as you said, it's the most anticipated SLOOS, report that we're going to get, because I think that's an insight into the availability. And when I look at like something like the NFIB report, and again, I can never remember what that stands for. People tell me it all the time, and I know but I look at that with credit tightening, the availability of credit. I mean, these are flashing that there's a credit problem in the smaller segment. So I think that's where, if the SLOOS confirms that, I see a big disconnect there. And this restocking that you're talking about, even though we talk about hospitality and leisure, I don't think it's like Marriott International or Hyatt that's doing all the hiring. It's the smaller and medium enterprise. So that's where I'm wondering, are we getting a different signal from the smaller pockets of the economy, which is more broad-based?
Mm-hmm. Yeah. I mean, I guess the capital markets, for that to be, justified, you'd have to say that while not only would those companies be okay because they're not as dependent on bank financing, but they won't get sucked down by the broader weakening in the overall economy that's primarily, hitting, at least initially, the SMEs.
Right. And then maybe the other way to think about it, again, I'm not a big fan of this argument, but I've heard it especially from credit folks. That's why it takes all kinds of move us around. But maybe it's like, rate cuts are coming, the curve's going to come down. And so the yields are right, just the spreads are too tight, but the prices aren't going to really go down because of that. I mean, that's bull market talk, I always say, from credit folks. But, because look, the curve is already reflecting lower yields, is what I'm arguing back to them. So, I mean, I see, like, if we're talking about, you saying that you believe there's a meaningful probability of recession in 4 quarters, then why are high yield spreads below average, right? That's what I struggle with. And some of this is like, I always just think of averages 500 because it's where CDX prices. We're in the high 400s today, but that's not recession spread levels, right?
Yeah.
And so that's the thing. If I want to find a market that's reflecting recession, it's commercial real estate, office related assets, right? And everybody's like, well, I know that, right? But that's a pocket where you can see it. And so I do think there is some differentiated approach here. And so I'm just wondering, that's why I was asking, are you getting a signal from the smaller banks at this point, these regionals? Does it cause you more concern than it did, let's say, 2 months ago?
So unfortunately, the data we have is not great, right? We have the weekly, and we started off by talking about the weekly H8. That also gives us not only the deposits after the initial shock. Deposits at small banks have been pretty steady, actually. I think it's a little hard to interpret the lending numbers, at least initially, in a credit shock like this. And I think we all learned that lesson in 2008, where early on after Lehman, bank lending data shot up. Well, it was people drawing down their revolvers and hoarding cash. So, I think you have to treat the lending number with some caution here, because that's not just going to give you a simple read of bank credit supply. and which again is one of the reasons I think the sluice is going to be looked at, because anytime you're observing a variable, you don't know if that's the intersection of supply and demand, of course.
Yeah.
And sluice tries to at least qualitatively tease out what's happening on the supply side, which is what we're all, I think, scratching our heads about, thinking about the outlook for the rest of the year.
Are there any other indicators that you're keeping a close eye on? I mean, we've talked about a whole host of them, and probably some esoteric ones that people don't hear about as often, especially when we do it by the acronyms there. But there's a lot of divergent views right now. They're based on some of these more traditional indicators like the yield curve. Just even the leading economic index on the year-over-year basis almost suggests that we're in a recession, but it certainly doesn't feel like we're in a recession. And if so, this is a recession, I think most of us would take it all day long, right? But are there any other indicators out there that you're looking at to kind of watch the trend shift or the inflection point and just say, hey, this is it?
Yeah, I wish I had a better answer.
The magic. Tell us the secret sauce there.
Yeah, the magic regressor. We mentioned a bunch of them. Jeff alluded to the NFIB, which is a small business survey. It has a bunch of interesting details in there. There are some surveys of households that talk about credit availability, but I think we're really more worried about credit supply to firms rather than to households. Households would be in pretty good shape as it is. So in terms of credit, the interesting thing is I remember after 2008, we discussed, we being the community of, analysts and researchers, that, geez, we didn't really have a lot of good ways to monitor this in real time. And then not much has changed to actually get a good sense of how credit supply is evolving. Maybe just going off the trail here a little bit at things. We talked a little bit earlier about the jolts, and job openings get a lot of attention now, where they used to not be at all until Chair Powell started calling them out. Now, I remember like a month or two ago, I think there was a jolts number that moved the market more than the payrolls did the following that same week. But I would say within there, the quits rate is something that is worth keeping an eye on. That's in a lot of
let's come down a little bit, right? And I mean, like, quits are a sign of like strength in the labor market, right? You quit because you think you can get something better, right? Yeah.
Right. So it's a sign of strength, it's a sign of confidence among workers in the labor market. And if you're confident, you're probably going to demand pay raises. And if you're less confident, you may be a little more hesitant to do that. So that's come down, and I think, and it kind of mirrors what you're seeing in the jolts and the job openings number. But when you use that quits rate and, like wage inflation models, it tends to outperform a lot of other variables. So, I'll keep an eye on that to see if that keeps coming down. I think maybe we can squeak by with this, immaculate disinflation that doesn't hurt too much.
Immaculate disinflation and the magic regressor. I feel like those are somehow going to end up in the teaser for this episode, Michael. I always enjoy picking your brain. I think you guys do great work there too. Before we let you go, too, let me just ask you too: what is the one thing that you think that potential market participants aren't paying enough attention to, or you can take it the other direction and say, what do you think people are putting too much weight on, one or the other?
I would have said, well, I still think actually the debt ceiling is probably, in my opinion, I just hear too many people I talk to, market participants, when I say I'm worried about it, they almost treat me like, Sonny boy, don't you know how this works? Every time we're going to get to the last minute and a deal gets done. And I say, all right, well, maybe, except two things are a little different right now. One, obviously, is the ability of a single member of the House to call a confidence vote on the Speaker. So even if you do have an 11th hour deal, it's not clear that you couldn't have a snafu that then has another battle for the speakership. So that's one thing. And then the other thing is, if too many people believe that line of reasoning that I just mentioned, Well, historically, we know what gets Congress to kind of take these things seriously is financial market panic, right? I mean, certainly we all saw that after TARP, the first TARP vote, right? Yeah. Now, if everyone takes this blasé approach, then maybe Congress doesn't think it's all that, requiring of immediate action. So I am, as I said, maybe it's definitely not a under the radar issue. I'm sure it makes every top 5 headline right now, but even so, I think the risk is maybe underappreciated.
Yeah, after watching Speaker McCarthy, take 15 rounds to get to that position, that doesn't instill a lot of confidence in the confidence of him or within him. But I have to always remind everyone he is from my hometown. So, but the one guy also from my hometown of Bakersfield is Dennis Lockhart, and I did get to meet him once. I had dinner with him, and I was just really stoked to have 2 Bakersfield guys sitting there talking shop. So great guy, by the way, too. Michael, it's been a pleasure. Before we let you go, too, where can our listeners and our viewers get access to your information? I know you do a lot of stuff institutionally, but what is the best way to be able to view what you're putting out there in the world?
Good question. So if you're an institutional investor and you have a relationship with JP Morgan, you can obviously go through your salesperson. Some of our stuff does go on our the JP Morgan Chase public webpage. So certainly, I believe, for instance, I think I'm going to have some little podcast after payrolls tomorrow. So some of that is available on our website.
Okay. Well, Michael, it's been a pleasure as always. I enjoy the conversation, like I said. However, before we let you go, Sam has a favorite part of the show that he likes to do, and so I'm going to let him introduce you to that before we let you get back to your job today.
All right, Mike, and that favorite part of the show, it's called Sherman Says. It's where I will offer a series of alternating prompts between you and Sherman, to which I hope to get a top-of-mind response for. To give you an example and pave the way, I'm going to give it off to Sherman with risk-free assets.
Winning, right? I mean, they have no risk and they're yielding, right? We got debt ceiling issues. Obviously, Michael's concerned about it, but the biggest competition for running a bond business is the risk-free rate today.
All right, over to you, Michael, with let's see here, regional banks.
Oh, I was going to say.
Oh, you get a different one. You don't get to think about these. Yeah, you don't get to think about these. No, everybody gets a different one. No, you can't listen to me and then get a better response. We have to live with what we say.
Although you could parlay it like Sherman, just use it on the next whatever the next prompt is too. So,
regional banks, coming from a rather large bank, I wish our colleagues in regional banks well, and I certainly hope that yesterday Powell said there are really 3 big banks that had them worried from the get-go, and if that's right, hopefully we pass the worst here.
Well, hopefully the 3 banks he's worried about were the ones that have been put in receivership, and it's not 3 more. But again, I'm with you. I would also say, because you say coming from a big bank, I would tell the regionals, welcome to the world of regulation, right?
Yes, that's true. That too.
Yeah.
All right, back to you, Sherman.
Speaking of colonoscopies.
All right, how can you probe it in this answer? Here we go.
Emergency cut.
Not imminent, but it will happen. And I think the first cut is deep. I don't think it's the 25 on the path as we were talking about today. I think it's probabilistically weighted. I think is it emergency? Is it planned? I think it's kind of emergency, but it'll be because it's late. And we're going to have pain, as Powell says, that it's going to have to be deeper probably than what's implied.
All right. Back to you, Michael, with Phillips curve.
Phillips curve. Broken. Well, I guess I would say I would repeat what you often hear in academic seminars. To beat a model, you need a model. Phillips curve is a pretty bad model, but we still haven't beaten it.
Yeah. That sounds good. Let's see here with Sherman, work from home.
The new regime, although we all live in kind of hybrids, we're all sitting in offices, I think it has a powerful thing. It has momentum, but it hasn't been recession tested. And that's going to be the model, I think, too, to see what happens in that next recession. So we'll have to see. It also depends what the recession looks like. So, yeah.
All right.
I know you're trying to get me to say we can all work from home, Sam. I know that's where you're going with that, but no, not going to happen on tape with compliance here today.
Not me. All right, over to you, Michael. Deglobalization.
Deglobalization. I would say so far more myth than reality. If you look in the data, you just don't see any declines in trade shares. I do believe in, look, I think friendshoring isn't, if that occurs, and even that, it's yet to be determined. I wouldn't necessarily call that deglobalization if you're moving operations from China to Mexico or Thailand. That's still a pretty globalized world, in my opinion. So right now, it's a big word, but we don't see it in the data.
Yeah, I agreed. Another big word that just makes me think of decoupling, which was thrown around a lot during the 08-09 era.
And that was about emerging markets, right? They've decoupled from the world, right?
Yeah.
Yeah. The only way to decouple from the world, Sam, as I tell you, is you've got to go to another planet. So
not happening for me. All right, let's go back to you, Sherman, with 2% target.
It is one until it isn't. But I thought Powell did a good job of saying that, 3% is not acceptable. We have a target of 2%. He's telling you those are the guideposts that he's trying to get to. And I thought that was a different tone that he took there too, because he's saying that our job is not done just because inflation's going to. He also knows base effects are about to really kick in over the next couple of prints, and I don't think he wants people to get so excited. So I think the 2% is the target. I think the post-mortem on all of this is that average inflation targeting was a dumb idea because you get this kind of spiral. I mean, maybe you disagree, Michael, but I think that's going to be the thing, is that they're going to be staunch about it. And look, it's not symmetric. 3 is way worse than 1 to them around the 2, kind of center point. And so I think that, that is the target. They're not going to get there this year without a recession. And so I think that it's just, he's staying the course, and that's why the high rate trickling through. And we're going to have to live with this higher interest rate regime for a while.
All right. Over to you, Michael, with super core inflation.
Super core. So this is core services ex shelter, correct?
Yes.
Because super core gets defined in a lot of different ways. That is the latest, greatest super core. It's fine. I would probably prefer the median, but I think supercore has some benefits right now. It will probably outlive its usefulness, before long. Another thing I would say is that this idea that, supercore seemed to be a way for Powell to kind of talk about the fact that he wanted to see a softer labor market without saying he wanted to see a softer labor market. But as I said, I think it has some uses, but I would, if we're going to do this in a way that's going to be useful still in a couple of years, I think something, again, like a median or a trim mean is probably a better way to exclude influential outliers than, coming up with ad hoc things like supercore.
I joked internally about it. So supercore is like, it's like the inverse of Maslow's hierarchy of needs, right? It's like, who needs shelter? Who needs oil? Who needs energy? Who needs food? If there's a water component, I was like, it's pretty much Maslow's hierarchy, right? So it's like, let's just chop the pyramid down. Who needs that? If it's just healthcare and education, those are stable. They just grow at the same rate all the time. So anyway, jokes aside.
All right, we got one last one. Let's put it in the speed round. One more for each of you. Sherman, free markets.
Let them be free. I don't know if we have them. I mean, we've been so, that's the problem, is that we all talk about capitalism and free markets, but we're afraid to let anything fail. And so, we all fail at times. Maybe not Michael, but we've all failed a little bit here. And so failures are growing, and you learn from it. So I guess I'll bring that back to you to say what Powell said yesterday, is that we're constantly learning. We're learning from our mistake. There is something about the humility coming out of Powell that I just feel that it's a little bit different, that tone, and it makes me feel better. Markets don't like it. They get more neurotic around it. But, this idea that it's all they're like omniscient and they have this all-knowing presence all the time, I think it's nice to see. So anyway, that wasn't your question, Sam, but that's where I took it.
Yeah. Yeah, and it wasn't a speed round either, but let's wrap it all up here, Michael, with favorite philosopher.
Ooh.
Well, when I was studying, it was probably Husserl. I'd say maybe Richard Rorty.
Look it up.
Yeah. You definitely surpassed our knowledge here. So we will be looking that up too. So Michael, thank you for the time. Thank you for bringing it full circle back to the philosophers as well. For our listeners out there, this is Michael Feroli. He is JP Morgan's Chief U.S. Economist. You should go to their website, check out the data. Further, we got more episodes of the Sherman Show out there. You can catch these on our YouTube channel, youtube.com/DoubleLine Capital. We obviously have these where podcasts are served out there on the iTunes, the Google, the Stitcher, SoundCloud, some other stuff that Sam does where you listen to his techno music on the side. And so in general, if you need more, if you want more of these, you can go out there and find them. Also, it's on the DoubleLine website, doubleline.com. Michael, thanks for spending time with us today. It was a pleasure. It was a lot of fun. Okay, and we'll talk to you soon.
Sounds good.
Okay, bye-bye.